Hello and welcome to another video on IND AS series from GJ Management Consultants. So we are here to present on IND AS 34, which is Interim Financial Reporting. So the key topics that we are going to cover today are objective and the scope, the definition of interim period. We'll understand whether IND AS 34 is mandatory, or I mean whether we need to publish the interim financial reporting as a mandatory step. Forms of the interim financial reporting. What is the treatment of the comparative information? Recognition and the measurement principle, whether they are going to get changed when we are doing the interim financial reporting. A concept of prohibition of smoothing, wherein we need to do the extrapolation, whether that is something that is done with respect to the interim financial reporting. What is the treatment of seasonality? How we are going to use the estimates when we are going to prepare the interim financial reporting. The treatment of income tax and the impairment in the interim period. How materiality definition is going to get changed when we're talking about interim. Is there any change, or if not, what is the concept of materiality in interim financial reporting? We'll talk about some of the selected explanatory notes. We'll demonstrate the comparison between the interim financial reporting versus the annual financial reporting, and then a quick comparative analysis between IND AS 34 versus IAS 34. So we'll move to the first slide to start the discussion. Okay, so objective of IND AS 34 is to prescribe the minimum content of an interim financial report. So basically, it speaks about that interim financial reporting is required, and then this standard helps us to understand what is the minimum content that is required to be published in the interim financial report, and then the principle of the recognition and measurement for the interim periods. These are the two topics which is going to get covered as an objective of this IND AS. And then when we're talking about scope, interim financial reporting is not a separate accounting framework. It is a shorter period application of the annual accounting. So conceptually, there is no difference between the annual financial reporting and the interim financial reporting. It's only the period for which we are reporting, and whether this is mandatory or not. We'll go to the next slide and have a look at that. And we'll try to compare this with IND AS with the IAS. So we have equivalent IAS 34, and it's absolutely aligned. So we'll move to the next slide. Okay, now we'll talk about what is the interim period. So, interim period, as such, the definition says that a financial reporting period which is shorter than the full financial year. So, which means that when we are publishing our quarterly financial statements or half-yearly financial statements, these are treated as interim financial reporting, because this is a reporting which is less than the full financial year, and then it has to be treated as the interim period. So, it is absolutely aligned with the IND AS 34. So, we'll move to the next slide. Okay, is IND AS 34 mandatory? Okay, so applicability. So typically we have to understand that why we have to publish this interim financial report. We have to publish this interim financial report because it is something which is required by the SEBI, and it is the stock exchange requirement as well. And wherever we have some specific requirements that from the loan or the organization that has given the loan or the management choice, then we have to publish these financials, which is interim financial records. So which means that applicability is driven by the SEBI, stock exchange and loan. IND AS 34 does not mandate who must publish the interim result. Examples are listed companies, quarterly results required by the SEBI. Unlisted companies, interim reporting is voluntary. So like we talked about the EPS. So EPS is largely for the company which has listed share or which is the process of listed. So which means that it is voluntarily, which is required for the other unlisted companies. Likewise, this is absolutely voluntary for unlisted company to report their financial numbers in the form of the interim period. And this is absolutely aligned with IAS 34. So move to the next slide. Okay, so what are the forms of the interim financial reporting? So there are two options. So two options are what? One of first option is that we can use the same set of financials that we are using for our annual financial statements. So which means that complete set of the balance sheet, P&L, OCI, statement of change equity, cash flow statement, the notes. Or we have another options wherein we can use the condensed form, most common, which is like condensed balance sheet, condensed statement of P&L, condensed statement of OCI, condensed statement of SOCE, and then selected explanatory notes. So which means that we do not require the full disclosure. We can use the selected explanatory notes, which were used to prepare the financials. So this is so there is as such no prescribed form. It's only talks about in what form and fashion the interim financial reports or the reporting has to be done. So wherein we can use the same methods, same format which we are using for the annual financial statement, or we can have a condensed form, and then we can use the selected explanatory notes. And this is absolutely aligned with IAS 34. So we'll move to the next slide. Okay. Now, when we're talking about the comparatives, so again, comparative has to be in the same form and fashion for the respective corresponding period for the last interim period. So, balance sheet as at the end of the current interim period, and then it has to be compared with the end of the immediately preceding financial year. For P&L, OCI, and cash flows, current interim period, then it has to be year to date, and then the comparable period of the previous year. So example for Q2 FY 24-25, P&L has to be for Q2 FY 25 versus the Q2 FY 24, and then H1 FY 25 versus the H1 FY 24. So basically comparatives has to be with the corresponding period for the interim period in which we are doing the reporting. If it is for a Q1, then it has to be have the corresponding figure for the Q1 for the last financial year. Likewise for the respective half year or for the respective quarters for which we are doing the interim financial reporting. And this is absolutely aligned with IAS 34. Move to the next slide then. Okay, now we'll talk about the concept of recognition and measurement principle. So fundamentally, as you also mentioned, that interim financial reporting is not a separate financial reporting. It's basically making sure that reporting is done at the more frequent interval as required by the stock exchange or the SEBI. So which means that same accounting principles and the policies as which we are using annual financial statement, and there is no special relaxed rules for the interim period. Which means that depreciation continues as per the annual estimate, provision recognized when obligation exists, and revenue recognized same as the 115. So there is no fundamental change in the recognition, the measurement principle. It has to be absolutely the same. This is the policy or the methodology that has been aligned with that has been adopted by the enterprise for reporting the annual financial statement. Same would be used for the interim financial reporting as well, and there is no gap when we are compared with IAS 34. Move to the next slide then. Okay, now we'll talk about the concept of provisional smoothing. So what does this mean? So basically, when we are saying that smoothing, so which means that we have to either extrapolate a particular expenditure, or we have to do the provisioning basis the specific period for which we are reporting. This is not the case. So which means that it is not permitted. So what means what? Which is what? So deferring the expenses to the future quarters, accelerating the income into interim period, or using the annual average unless appropriate. So basically, we have to adopt the same method as we are adopting. For example, if a particular expense which is getting provisioned in a particular month of a quarter, then it has to be done in that month only. It should not be like it has to be either deferred or it has to be a portion to the subsequent quarters or specific period for a particular quarter. No, it has to be the same methodology in which it was being adopted as per the policy of the company. So which means that like for example, annual insurance premium is 12 lakh, the monthly recognition is 1 lakh, so Q1 expense should be 3 lakh and not 12 lakh. So which means that this is absolutely in alignment with the annual financial statements, and there is no extrapolation or deferment or ad hoc provisioning that is required for the interim period as a specific cases, and it has to be absolutely aligned with the policy and the uh, ways of presenting the financial statement that is being adopted in the annual financial statements, and this is absolutely aligned with IAS 34. So we'll move to the next slide. Okay, now we'll talk about the seasonality treatment. So, which means that seasonality does not justify the deferral or anticipation. So we cannot do any adjustment in the numbers with respect to any anticipation or seasonality. For example, we have taken example here that let's say there is an ice cream company for which 70% of the sales occur in Q1. So which means that we have to recognize the 70% of sales in the Q1 only as per the principle of the IND AS 115. It should not be like we have to apportion that into the number of the month, and if let's say we have a quarter of Q2, Q3 and Q4, then we should do some deferment into Q2 to Q3, Q4, just to make sure that we have the sales throughout the financial year. If it is the case of 70% happens in Q1, then it has to be reported in the Q1 as well only. We can give at the max some explanatory notes that mentioning that the Q1 sale is 70% of the 70 in the later interim period, that the Q1 sale was the 70% of the total annual sales. So that can be given as a perform of the explanatory statement, but our principles of adopting the and representing financial statement will not going to get impacted for any seasonality. So still recognize revenue when earned and no averaging across the quarters. And this is absolutely aligned with IAS 34. Okay, now we'll talk about the estimates. So definitely when we are reporting the financials at the quick frequency on a quarterly basis, then definitely our estimates require some reassessment. So that is something that has happened basis each quarter, but that should be reasonable and consistent with the annual estimates. As simple as that. It should not be like very fluctuating, or actually it should go beyond the policies or the procedure that is being adopted by the organization for the preparation of the financial statements. For example, inventory NRV, which will be done on the quarterly basis, because we have an opportunity to do that estimation on the quarterly basis because we are reporting the interim financial reporting, bonus provisioning, expected credit loss, and the income tax expenses. So fundamental rule is that because we are reporting the financials more frequently, and hence we can have an option of doing the estimation, but it has to be a reasonable basis and it has to be aligned with the fundamentals of the annual financial statements. And this is absolutely in line with the IAS 34. So we'll move to the next. Okay, now for income tax, one thing that needs to be kept in mind that it's not going to get impacted with the interim financial reporting. We have to take the annual ETR rate to estimate the income tax for the deferred taxation purpose. So income tax expense is calculated using the estimated annual effective tax rate. So we have taken an example here. The estimated annual profit is 10 lakh, estimated annual tax is 3 lakh, AETR is 30%. Let's say if we have the Q1 profit of 2 lakh, then our tax expense would be 60,000, which is the 30% of 2 lakh. So this is the annual effective tax rate which we are going to take to do the calculation for the tax expense at each quarter. So it's not going to get impacted on each quarterly basis. Our AETR is not going to get impacted by each quarterly. We have to adopt the AETR of the last reported financial, and we use that AETR to do the tax expense for each quarter. So move to the next slide. Okay, now we'll talk about the impairment. So as we know that because we have the more intervals, more frequent reporting, and we have 4 financial reporting period when we're talking about the interim financial reporting, because we have the 4 quarter, and then definitely we have more chances to test the impairment at each financial reporting period. So asset tested for the impairment when indicators exist. So this is as per the IND AS 36. Goodwill impairment recognized in interim period cannot be reversed in the later interim or the annual period. So typically, we know that the goodwill impairment is tested once in an annual basis, and if that particular month falls in a particular interim reporting period, then we have to test that impairment at that particular interim period. But the fundamental rule is that once it has been tested for the impairment and there is a fall in the value of the goodwill, that impairment loss is something that cannot be reversed in the later future interim period or the annual period. So this is as per the IND AS 36. So impairment recognized in Q1, if that's a PP is it yes, conditions improved, reversal allowed, and in recognition originally interim irrelevant, financial repair reversal considered. So which means that if we have done our impairment in a particular quarter, but if let's say condition improved, then there is a reversal is there, and then we have to consider that reversal when we are presenting our annual financial statements. But for the goodwill impairment recognized in Q1, yes, condition improves in Q3, there is no reversal and it is irrelevant, and there is no reversal in the annual financial. This is in line with the IND AS 36, and this is absolutely in line with the IAS 34 when we are comparing it with the IND AS 34. We'll move to the next slide. Okay, now we'll talk about the concept of materiality in the interim period. So rule says what? Materiality is assessed with reference to the interim period financial data and not annual. This is very, very important. So if let's say my policy is there wherein we are saying that example is that 50 lakh expense seems to be immaterial when we are comparing with the annual statement annually, but it seems to be material when it is a quarterly result. So let's say if my materiality threshold is a percentage base, and if my percentage is less as when we compared with the annually, but it is breaching the threshold limit when it is interim financial reporting, then it has to be reported as a material item and disclosure is required as per the IND AS 1. So which means that materiality has to be considered as each interim reporting period, and it cannot be assumed that because it is immaterial for a particular item to be shown separately for a annual period, and hence it is not required to be shown interim. No, this is not the case. So each interim period has to be assessed separately when we are trying to put the concept of materiality. So we'll move to the next slide. Okay, now we'll talk about certain explanatory notes that are selected explanatory notes that are required to be disclosed with respect to the interim financial reporting. So this is change in the accounting policy, seasonality, unusual or infrequent items, changes in estimates, issue buyback of share, dividends, contingent liability, defaults, related party transactions. So all these are the selected explanatory notes that are required to be disclosed as a part of the interim financial reporting, so that the user of the financial statement can do their assessment as per the information that has been provided. So we'll move to the next slide. Now we'll quickly spend some time in understanding the difference between the interim financial versus annual financial reporting. So we have created a table here. So focus of the interim reporting is to ensure the timely information, but for annual reporting is the complete information. Because why we're saying interim reporting is timely information, because when we're talking about timely information, it's like quarterly information that is prescribed by the SEBI and the stock exchanges, or if let's say there are certain covenants for the loans that has been provided to the entity, then for that cases it is being required at a periodic interval, which is like normally a quarter or half yearly. And estimates which are more frequent in case of the interim financial reporting, but for annual reporting is more refined because we have the view of for the full financial year. A disclosure is condensed in case of the interim financial reporting, but in information it has to be full disclosure, and this fundamental is absolutely aligned with IAS 34. So we'll move to the next slide. Okay, so this is the last slide, and if we try to compare the IND AS 34 with IAS 34, there are no differences as such. It's fully aligned. Conceptually, it is same, and there is no differences for any principle or any of the other matter, whether it is materiality, recognition principle, tax calculation, or with respect to the disclosures or the form of the balance sheets or the financial statements. This is the last slide, so we'll move to the final slide, which is a thank you slide. Okay, so I would like to thank all my viewers and subscribers for watching this video till the end. Please cascade this video to any person who feel that this would be of help to them. And we are going to come up with the new IND AS very soon. Till then, thank you and have a good day. Bye bye.